Hello, fellow Rebel Capitals. Hope you are well. We have a lot to go over. The new jobs data shocks the market, and the Fed comes out with a study that I think will answer a lot of your questions. It'll all start to make sense here in a moment. But let's first and foremost go to the jobs number. The JOLTS came out today. Holy Toledo. Look at this. U.S. job openings climb to the 6-month high. That's good news. The bad, and this is where it starts to get a little weird, businesses aren't hiring very quickly. Now, before we get into this, I want to back up a little bit and look at what the market was expecting. So you can see the calendar. Last month, we had 7.4 million. We were expecting, the market, was expecting 7.3 million. So a decline due to uncertainty, the job market weakening, the economy slowing. But instead, job openings skyrocket to 7.8. So it's not just, oh, it's pretty good or it's the best in 6 months. I mean, this is 500,000 more than expected. I mean, that's a big deal. That's a big deal. And ISM beat the numbers, although it's still in contraction. Remember with the ISM, anything under 50 is contraction. But I mean, this in and of itself, I mean, you just look at that at surface level. That's great news. So that's why I put in the thumbnail the picture of Trump saying, I told you so. I told you so. These tariffs are going to bring back a lot of jobs. The United States economy, it's going to be booming. But then once you kind of look underneath the hood, things start to change. And oh, by the way, you got to sit down for this video because in a moment, we're going to go over that report from the Federal Reserve talking about the state level GDP. You guys are going to find this fascinating. But in addition to that, I want to look at Florida more specifically and think about what's happening to the real estate market there and how that in and of itself could be a canary in the coal mine for the overall economy, and then how that leads into what's happening with the dollar, interest rates, Fed cutting, etc. So you guys are going to love this video. It's going to be great. So let's go into the details here. Oh, and by the way, I said yesterday that I was interested in the construction spending. That was actually a miss, negative 0.3. Okay, but getting back to the jobs here, some details. New job postings rose to 7.77 million at the end of May from 7.4. Okay, we got that. Number of job listings has held steady in 2025, a solid 7 million plus. Is hovering near pre-cerveza sickness levels. Okay, so far I'm following them here. New openings have, okay, we got that. After the cerveza sickness, the new job openings skyrocketed. Here's where it gets weird. Yet while job openings appeared to be plentiful, the rate of hiring has fallen below normal. Huh? So you're telling me the jobs have gone straight up, but the amount of hiring is going down? Doesn't make any sense, does it? Many businesses have put off new hires until they see the outcome of trade wars. And they get a better sense of whether the economy will speed up or slow down. I added slow down. Well, if this is the case, then why are they putting new job postings? Why are there more job openings if they're not hiring due to a potential economic slowdown or uncertainty? See, it's still not making a lot of sense. Let's keep going. Other surveys also showed jobs are harder to find. Not good news for college and high school students looking for full-time jobs after graduating. I think a lot of this has to do with AI. And if it doesn't have to do with AI now, I think especially the white-collar jobs and all of the traditional majors that kids would take in college to get a quote-unquote good job after school, a lot of those are going to be off to the robots, off to AI, but we'll save that for another video. So the details here, they say the increase in job openings was a surprise, but more available jobs translated, or there's a typo here, did not translate into faster hiring. The so-called rate fell a tick to 3.4%, putting it close to the post-Cerveza sickness lows. The hiring rate typically ranges from 3.7. So I think what they're saying here is usually out of whatever 100,000 job listings in the Jolt survey, you get 4,000 hires, roughly, 4%. So what's weird now is you've got 100,000, or now you've got 110 because it was higher than expected, going up to 7.8 million, 7.7 million, whatever it was. But the rate of hiring per job listing is going down. So what this tells you is that the people that are applying for the job are just not that qualified, or there's something goofy with the Jolts numbers, that they're somehow a little bit rosier than reality. The new job openings were mostly concentrated in hotels and restaurants as they prepare for summer. Yeah, but isn't it seasonally adjusted? You would think it was. I don't know the answer to that. New listings soared by 314,000. Jobs held in government fell. Yay, good job. Okay. Want to give Trump and Doge a hat tip there. Good job, Elon. And a bit of good news, most companies are avoiding layoffs. Yeah, but this is what always happens in these cycles. It's definitely a great report that we've got to pay attention to. But you can also say that this is a total outlier and doesn't really make sense. Now, I think we just need to see what happens over the next month. I think non-farm payrolls coming out on Thursday is going to be huge. And we'll just have to see, how that pans out and, what the trend is here. But there's just so much of the economic data that is conflicting, which is why you had a big upside surprise. Businesses are not hiring or firing people. Okay, then why are they posting a lot more jobs? You see, again, this doesn't really make a lot of sense. You've got like 90% of the data that's okay, slow down, we're not hiring, we're not firing, we're pausing, uncertainty, we're not the amount of postings we have as a percentage of that, we're hiring a lot fewer people than we did in kind of economic normal times, if you will. But yet we're posting for a lot more job opening. It's weird. Hiring remains depressed, but that is less worrisome because layoffs remain low. But again, this is what happens every single time in the cycle. It's not black or white. It's a various shade of gray. And as the economy goes from, I'm not going to say running on all 8 cylinders, but doing okay to slowing down to potential recession, it doesn't, you don't go from higher, higher, higher to fire, fire, fire. You go higher, higher, higher. Then you go don't hire, don't fire. And then you go to the firing. So a mixed bag here for sure. This is not what I was expecting. I was expecting a lower number. But the other data that came out with this is has you kind of scratching your head on this headline number to see if this might just be kind of a one-off or an outlier. So let's go over some other things here that I think really, for those of you who believe we might not be in a recession as defined by the NBER, but the economy isn't doing that great. And for, let's say, 75% of Americans, for them, it is a recession. I mean, how many of you watching the video right now would fall into that category? You go ahead and raise your hand or let me know in the chat. I'm sure it's the vast majority. When you talk to your friends and family members, they're not out there saying, oh my gosh, it's so easy to get a job. Oh my gosh, my wages are increasing so much, or my income is increasing so much faster than my expenses. This is just an economic miracle. My standard of living is going up so fast, I can't even take it. I think instead of that, most of you from your friends and family members are probably hearing the opposite. Like it's getting harder and harder to put food on the table. It's getting harder to put a roof over our head. It's getting harder to pay insurance costs. And if I do lose my job, I'm a little more worried than I was a year ago or 2 years ago, and that I don't think I can find as good of a job. Maybe one that pays less, but it might take me a while. And I think this is what most Americans are feeling. This is the life experience, if you will, of most Americans. And then when you turn on CNBC or Bloomberg, or you look at the financial media and you hear, oh, no, the economy's doing great, or oh, no, the JOLTS numbers blow out, or oh, no, we're not even close to recession. You kind of just sit there and like, well, okay, I mean, if you say so, but it seems like everyone I know is basically in recession, and it's getting harder and harder and harder. And so I don't know, when you say that there's no recession, NBER, I guess I've got to take your word on it, but I don't know if you're living in the real economy or you're just living on Wall Street. Because yes, for those people with assets, life is good. There's definitely not a recession. Their economy is booming. But that's a small minority of Americans that really, really impacts. So let's go over to this Fed survey that came out, I believe today, that I really think helps us understand what's actually happening here. And it helps us make sense of the economic data. And it helps us make sense of why it feels like we're in a recession or an economic contraction, but the NBER just hasn't come out and said it based on their econometric models, assuming there's no bias. Let's go over to right here. This came out, this was yesterday, and this is the Fred blog, and this is real GDP growth by state. So not as a total, but by state. And inflation adjusted. I said real GDP, but just so we're all on the same page. This is GDP growth adjusted for inflation. Notice something? So the green is where you have an increase of GDP. The red is where you have a major contraction. And the light red, pink, is where you have a minor contraction. So still contracting. So what I want you to do real quick here is just, you don't have to be precise, but look at how many green states there are and look at how many pink and red states there are. There's a hell of a lot more of red and pink. In other words, there's a hell of a lot more of the states that are actually in an economic contraction. In other words, recession. So when people are watching my videos and they live in New Mexico, Kansas, the Midwest, Nevada, Oregon, they're like, wow, yes, absolutely. The economy sucks. I mean, none of my friends can find jobs. But then those people that live in South Carolina are like, woohoo, the economy's doing great. I don't know what you're talking about, George. You're just being a doomer. You're just you're just all doom and gloom to get clicks. This is all clickbait. The economy's in fuego, baby. I think this really says a lot, doesn't it? And it really helps kind of make sense of the life experience of a lot of our friends and family members. Maybe we put you into that category as well, versus what you're hearing in the aggregate data. So you're kind of on the brink. You got very low growth, and last quarter, even nationwide, it was negative. But you've got very low growth, but it's just being propped up by a few states here. Just a few states are what has the aggregate total just teetering and just slightly leaning on the side of not recession, where if you lose a couple of these states, especially like Florida, this is what likely tips you over the edge into an outright recession where, and I'm defining that as a recession or an economic contraction, that the NBER would actually come out and admit, yes, we not only had 2 consecutive quarters of negative GDP, or maybe just 1 consecutive. It doesn't always have to be that in order for them to announce it. But due to all their econometric models, we can definitively say that we are in a quote unquote recession. Doesn't mean that it's an economic collapse or anything like that, but it's just a confirmation of what all of these people are experiencing in the real life. And what are the actual numbers here? Look at this. 39 of 50 state economies contracted. Let me read that again. And this is not George Gammon saying this. This is not Zero Hedge. This is the Fed. 39, which begs the question, how on earth are they not cutting right now? But we'll save that for the end of the video. 39 of 50 state economies contracted in the first quarter. The median state contracted 0.64%, but 28 other states had slower growth than the average. So, as an example, Nebraska and Iowa had the steepest contraction at 6.1%. Negative 6.1%. These are, I don't care how bullish you want to be. I don't care how, I don't care how incredible you think the economy is. This is a real number. Nebraska and Iowa, in 1 quarter, had an economic contraction, adjusted for inflation, of negative 6.1%. That is staggering. I mean, I would actually be interested to know what they were during the GFC, because I can't believe they would have been, the numbers would have been that extreme, at least for Nebraska and Iowa. But then you had South Carolina right here that had a 1.7% annualized growth, and they were the fastest. So look at this. I don't know how the best state can be at 1.7% growth, and the worst 2 states can be at negative 6.1%. You have an average of 0.64 negative. You have 28 states having even slower growth than that. I don't know how you can look at this and say, oh yeah, the economy is strong and resilient. What are you smoking? Again, maybe it is strong and resilient in a couple of states, but when you look at all of the states, you see that for most people, the economy is terrible, horrible. And I don't have the data in front of me, but as far as Nebraska and Iowa go, I would assume it's even worse than the GFC. So now let's look at one of the states that is, the most populated here, that I think is, well, it's obviously propping things up, because if it has a huge population, then that's going to contribute to the aggregate total of GDP more than, say, Montana, as an example. And by the way, Montana in at a negative 4.4. Jeez. Wow. I'm just hovering over some of these here. Really staggering. Wyoming in at a negative 3. Texas in at a negative 0.05. That's really surprising. I mean, I thought Texas would have at least been a positive. I know the housing market there is going down a bit, but and you look at all the positives, and they're not that great. I mean, they're teetering right on the edge. So let's focus on Florida here. 1.4%. So it is definitely one of the best states and one of the most populated in the green section. So my point here is, if this goes to red, that is going to have a huge impact on the overall GDP. which could be the tipping point for the NBER coming out and saying, okay, yes, finally, we're in an economic contraction. So let's go over to this next story that I can assure you it is stiff drink time. If you're not sitting down, you need to be sitting down right now, because this is scary. I mean, this is really some scary stuff. Let's look at this Wall Street Journal story from today. From today. The worst housing market in America is now Florida's Cape Coral. And what's weird is, as most of you know that have been kind of OGs of the channel, I lived in Cape Coral I was there for 4 or 5 months. It was just before the first Rebel Capitalist Live. And so I remember it well. A very nice area. Not a lot to do, though. But great for boating and fishing. I actually had the house I had isn't shown here, but it was just like this, where it was right on the water and you could go out there at night, go fishing and everything. It's really cool. But there wasn't a lot of trendy parts, not too many things to do, more of like a retirement community if you've never been there. But look at this. Median home price soared nearly 75% in 3 years. Okay, that was the last 3 years. That ain't now. Now it's the rubber is meeting the road here. And before we get into the meat of this article, I want to remind everyone, what is the bull story, or what is the bull narrative, the argument for why home prices in the United States will never go down and therefore never have a negative impact on the economy? It's all supply stuff, right? All supply. And you've heard this for years now, that, prices are never going to come down because we're undersupplied. And I was always like, yeah, I mean, that doesn't seem like a great argument to me, because if demand gets down to a certain level, then you're going to be oversupplied, even if historically that is low supply. And if incomes aren't going up, and if incomes are actually decreasing, then it's going to force people to sell, and that's going to increase the homes for sale, although it might not increase the total number of homes. And then the argument was always, well, no one's going to ever sell their house or have to sell their house because they've got a 30-year fixed rate mortgage that's locked in at 3%. And I was like, that doesn't seem like a very good argument to me either, because if all your other costs are going up except your mortgage, what's the difference between that and your interest rate going up? So as an example, if your mortgage payment goes up by $500 a month and that forces you to sell your house, is it any different than your property taxes or your insurance going up by $500 a month and that forcing you to sell your house? And oh, by the way, if the unemployment rate goes up, if the job market slows down, then I don't care if you have a 500-year fixed rate mortgage at 1%. It doesn't matter. If you lose your job, you're not going to be able to make the mortgage payment, and you're going to have to sell the house. That's going to increase supply. It's going to drop prices. Now, hopefully, people have some equity in there. But look, a lot of these people, you would have had to have a lot of buying in Cape Coral to have an increase of 75%. So you see, a lot of these people didn't buy in 2015. A lot of these people bought in 2021, 2022, and therefore even a slight decrease is going to completely wipe out their equity. But let's keep going here. So some of these pictures are crazy. Wait till you see the picture of this boat. It's actually up. They're doing foreclosure tours. I mean, I had no idea until I read this article or just kind of scanned it here. So here's the median change. You see this huge spike, and then all of a sudden plummet, and you have a couple reprieves here, but for the most part, it's just negative, and now it's even getting worse, to the point where in 2025, the average value of a house has gone down by $26,000. So here's where I started highlighting. Housing markets throughout the United States are grappling with one or more factors that can hurt home sales and prices, including high mortgage rates. But Cape Coral is suffering from nearly every affliction that can cause a housing market to slump. But okay, yeah, I get it that they're suffering from this. But the question is, what would prevent other markets from suffering from this, right? So it's you can't argue that it's all about population, because the population has boomed in Florida and they're still having these problems, right? But let's look at this next paragraph. The metro area, about 800,000, is feeling the effects of elevated home prices, blooming insurance payments. Okay, so insurance payments going up. Is that something that's exclusive? No. I think all insurance payments are going up. Now, they're probably going up a lot more there because of the hurricanes. That's for sure. But I don't think you can sit there and say that just the insurance costs going up is something that's exclusive to this market. Property taxes, I don't know why they're not going up nationwide. Natural disasters, we talked about that with insurance premiums. Return to the office. I mean, if anything, that's going to have a lesser effect on Cape Coral because you have so many retirees. And waning demand from investors after a glut of building in the area brought rental prices down. It wasn't really a glut of building. I remember I was there. There wasn't that much building going on. I can assure you. At the height of the frenzy, the migration frenzy, Cape Coral is located, had 3,500 homes available for sale, now 12,000. So this is kind of the data I would present to someone that says home prices will never, ever go down because we're undersupplied. Yeah, but that can change pretty darn quickly. So I think there's a difference there between the number of homes we have and the population and the number of homes that are actually for sale. The number of homes for sale can change rapidly, which can dramatically impact prices, obviously. With so much supply, very little demand, and seller base where over 50% are cutting prices, I would expect the downward trend to continue. And this is Parcel Labs. I assume that they're a research company for real estate. Now let's talk about some personal stories. These people are screwed because they basically bought, they're trying to sell, and they've done 15 price cuts over the last 2 years, and they still can't sell their house. I just hope we end up selling. It's not so far down below our asking price. It puts us in debt. Equity gone. They talk about how the apartment market is lagging there as well. What I want to focus on here is the single family. The cost of living down here doesn't match wages. So now they're talking about these people that are trying to sell their house and at the same time trying to just pay the bills and pay the expenses. So their equity is getting wiped out. And at the same time, they're going out there trying to find work, and they're saying that the cost of living doesn't match wages. Does that sound familiar? I mean, let's go back to this, right? Let's go back to all the pink and the red here. How many people do you think that live in, Montana or Nebraska, where they've seen a negative 6% contraction in Q1, annualized? I mean, how many of those people are in the exact same position where the cost of living doesn't match the wages? They say this is a paradise, but there's no work. Everyone's begging for work. And look at this. Josh, this is what we should have used for the thumbnail. Look at this. I've never seen anything like that. Foreclosure boat tours. And they're free.
I wonder if they're selling those mud boats we were on in Miami.
No. This is what they're doing here. Is they're putting everyone on a little pontoon boat or whatever this is, and they're taking them up and down the canals, and they're just showing all of the homes that are in foreclosure right now in case there's a potential buyer here. It's just because there's so many canals in Cape Coral. It's easier, I guess, to do it by boat than it is by van or by bus. But that's unbelievable. Oh, wait a minute here. Excuse me. Whoa. Time out. Okay, I didn't read the fine print. This is not happening now. This is not happening now. Okay, they said this is a boat tour. This was in 2009. Ah, okay. That makes more sense. I knew things were getting bad here in Cape Coral, but I didn't think they were that bad. I mean, so they're showing a picture of what happened in 2009. Okay, that makes more sense here. All right, Cape Coral was also the epicenter of 2008 subprime. So you say, okay, George, well, this is nothing like that. Well, they don't have boat tours yet, I guess. But let's keep reading. This time, so now they're comparing it to 2008, 2009. This time, Cape Coral homes were bought with cash. So they're saying it's not the same because we didn't have as much leverage in the system. There weren't all these subprime mortgages. A lot of these homes were investors, therefore bought with cash. But let's keep reading. New regulations require stick underwriting and more money down. Still, economic uncertainty. It's like a but, right? That's a big but. Still, economic uncertainty and the increasing cost of home ownership are causing prices to fall fast again. So you have all these people that say there's no way that home prices can fall in the United States because this time it's different. This time it's way different than the GFC. Well, okay, I agree. This time it is different. You don't have the degree of subprime. There are some components that have changed, but that doesn't necessarily mean that prices can't fall. I mean, prices can fall for a variety of reasons. And just because there's a fixed rate mortgage or cash, it doesn't mean that supply can't go up a hell of a lot faster than demand, which is exactly what we're seeing in Cape Coral. And also, although it's not as bad in the rest of Florida, I think overall, in aggregate total, prices are coming down. So now let's go back to this, guys. Now you know why I wanted to focus on Florida? Because you guys know from watching my video, and just because you have good old-fashioned common sense, the United States economy, to the degree to which it is propped up, and it sure as hell isn't propped up in these 39 states, that's for sure, but the degree to which it is propped up, it is propped up due to asset prices, or even, in these states here that have a negative GDP, it would have been a hell of a lot worse if it wasn't for asset prices. So what happens when you have this leg of the stool that starts to wobble? And I'm not saying every single real estate market is going to go the way of Cape Coral. I'm not saying that. I'm just saying it shows you the vulnerability. And if you have this happening throughout Florida and you have overall nominal prices going down, what does that do to the local economy? Well, you see what it's doing to Cape Coral. That's for sure. And if this happens, maybe to a lesser degree, but it happens throughout the state of Florida, what does that do to this positive 1.4? That takes it to a negative 1.4. And then what does that do for the aggregate total here of GDP? And by the way, I would like to see a timeline. You see those motion timelines like on Twitter where they show you that pictograph and they show you the changes over like a 5-year span. I would be very curious to see the amount of red. In fact, I'm going to do that for tomorrow's video. I'm going to go back and see if I can find this exact same map of the United States, heat map, if you want to call it that, and see where it was in 2024, see where it was in 2023, 2022. And I would place a lot of money on the amount of red and pink growing massively year by year. So you just have to ask, okay, by next year, assuming this trend stays the same and some of these real estate markets slow down, especially because the real estate markets were the ones that really boomed here in the southeastern region. Maybe not as much as Florida, but you're likely going to have a similar dynamic here. And if that pillar starts to wane, then what's propping up the economy? Probably nothing. And nothing's preventing it from going into recession to where let's just say 45, 48, 49 states are actually in the red or the pink. So that takes us back to what I've been talking about a lot lately on the last few videos, is what's happening in the dollar. And we see the dollar 96.74. We've seen a dramatic decline, especially over the last, let's say, 3 weeks or so, that you couldn't really explain with Trump and tariffs and all the foreigners dumping dollars because they wanted to or they have to. It's really, in my view, due to interest rate differentials. So as the data softens, as the probability of the Fed decreasing rates and taking it, and then the probability increases that the ECB is going to hold. When you have those two factors and that spread converges, you would assume the DXY would go down. That doesn't mean it crashes, or, well, you could say that it has crashed this year in percentage terms, that's for sure. But it doesn't mean that it goes into toilet paper mode where you go into hyperinflation or something like that. It just means that it goes down to 95, 90, something like that, which is well within a range that we've seen over the past 10 to 15 years. So if the market is predicting that the interest rate differentials will decrease, therefore, this is the price action that you're seeing in the dollar. And by the way, it's the price action that you're seeing in the treasury market as well. Then what this is telling us is the Fed is likely going to drop maybe more than the CNBC types think they're going to drop. So this provides a great opportunity. So what we'll do here, and I just did a video yesterday on what I'm doing in my own personal portfolio based on the signals that I see from the dollar. So I'm calling it the Dollar Playbook. I kind of wrote this down. Catchy name, huh? Dollar Playbook. And it's how I'm trying to profit from the next big move in the dollar. Now, let me be clear. I'm not taking a directional bet one way or the other. But what I'm doing is looking at these big moves in the dollar, and I'm saying to myself, okay, what is this telling me about the interest rate differentials or the expectations for rate differentials or the expectations for Fed funds? And then what is this telling me about the underlying economy? And then how can I utilize this as an opportunity to put on an asymmetric bet? So there are no certainties, only probabilities. And this isn't investing advice or anything like that. I'm just sharing with you guys what I'm doing in my own personal portfolio, because I truly think there's a fantastic opportunity. The asymmetry is there, where the probability is very high that you're able to have a winner, and you've got a substantial hedge in there as well. And so I'll kind of leave it there, leave it as a cliffhanger. I'm not going to let the cat out of the bag, but it's really my dollar playbook. And again, it's my playbook based on what the dollar is telling me, what these big moves are telling me about what's happening with macroeconomics, with the Fed, and therefore interest rates, and how I see a pretty neat setup that you very rarely get, where the odds are definitely skewed in your favor and the upside is way more than the downside. So it's a free video. It's just we're using it to build the email list. So Josh puts it right here in the chat. For those of you on the podcast, it's rcp.georgegammon.com/dollar playbook. And I know the editors have been putting it in the description of the podcast if you're someone that listens to this on Stitcher or iTunes. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market, capitalism, and we'll see you in the next video.